Okay, folks. Most of you have picked up your quizzes, but there are a few still left behind. At the end of today, I'm going to bring them into my office. So if you haven't picked them up by so I'll leave them out for about another 45 minutes after the class, because I want to bring them in simply because I can't leave them out there. It'll go to recycling or some bad things will happen to them. So I will bring them back into my office. And again, remember, it's just the first quiz. Now, either way, so if you did really well, it's just the first quiz. If you did really badly, it's just the first quiz. So kind of let that thought go. Okay? There are a couple of things. One is I was a little troubled by math issues, not finance issues. Things like order of operations, things that you just have to be careful about. Brackets are there for a reason. Right? So if you get an unlevered beta that is higher than your levered beta, it's because somewhere along the way something got messed up. Okay? But there's one other thing I wanted to, it's kind of a loose end that some of you might be thinking about. I've been nagging you about picking a company and valuing it. And towards the end of this month, I think March 29th, I give you a one-time deal, which is you send in your valuation, not for a grade, but for feedback. And I've had a few questions about what exactly am I expecting on March 29th. I expect an Excel spreadsheet with the evaluation, not a write-up, nothing, but basically an Excel spreadsheet. And what I will do is I will check it for consistency, not correctness. Why? Because I don't know what the correct value of every company is. If you think I do, you think I know things I really don't. But I will check it for consistency. And I will send it back to you. And you can fix it. You can. Some of the things I would say, do you really want this input to be what it is? And if you say yes, hey, it's your valuation, it's your company, it's your story. But that's March 29th. And by the time we get to the break, which will be on Wednesday, you will have everything you need to actually do your discounted cash flow valuation. Few people have asked me whether you can use my Excel spreadsheets. Of course. Just don't make it a black box. And if you do, take responsibility, which is it's still your valuation, not mine. So take on that responsibility. I have no problem with you using one of those Excel spreadsheets, using my data. This is not an Excel modeling class. I'm not expecting you to build a model. And frankly, it's not a great skill set that's going to get you a lot of money in the future. There are a lot of people who can build Excel models. So if that is your skill set, is I'm going to build great Excel models, all the more power to you. But this isn't the class. So I want you to focus on the valuation part, which means if you have to get the data and the models, it's fine. Okay. So let's continue. Today we're going to talk about growth and what really drives growth, because we've talked about historical growth and why it's not a very good predictor of future growth. We've talked about outsider estimates, analyst estimates of growth, and why it doesn't help you that much. And today we're going to talk about fundamental growth. But before I do that, a couple of things to start the class off. When we're talking about growth, the analyst estimate of growth, and I said you could pull it up for the next 5 years for your company, and many of your companies you can. Go to Yahoo Finance or IBEST, you can pull up the growth rates. Which of the following should you worry about if you're using that in your valuation? The first is the growth is estimated in earnings per share. Analysts tend to think in earnings per share growth. That's the number they're forecasting. Second, the growth is highly correlated with historical growth. Analyst estimates of growth tend to reflect what's happening historically. The third is the growth rate is not a good estimate of future growth. The fourth is if you use an analyst estimate of growth, it's really not your intrinsic valuation. It's somebody else's story. Which of those do you think is a problem? Is it the the growth rate in earnings per share being used as a growth rate in revenues? Because let's face it, that's what analysts project, earnings per share growth. Using it as growth in revenues will end up overvaluing your company almost every single time. Because as you move down the income statement, your growth rates start to get higher and higher. So that's a problem. It's highly correlated with historical growth. That turns out to be true. If you want to predict analyst estimates of growth for many companies, all you have to do is look at past growth. And what do we say about past growth already? It's not that good a predict. So in a sense, you're getting almost a reflection of past growth, and that doesn't help you that much. So it's a problem too. We talked about how analyst estimates are not that good predictors of future growth. That's a problem as well. In fact, every single one of those things is a problem, which is part of the reason I want you to steer away from just plugging in an analyst estimate of growth or assuming that they're right and trying to reverse engineer what you project as growth for your company. Today we're going to talk about invested capital, how it's tied to growth and what it is that drives growth. So I'm going to give you a very simplistic example. Let's assume you have a company that has $1 billion in invested capital. Invested capital is what they've already put into the business. Let's say right now they're generating a return on capital of 7.5% on that billion. It doesn't plan to reinvest in any new assets. It'll maintain the existing assets and the current return on capital. So basically, if you have $1 billion in invested capital, 7.5% return on capital, nothing is going to be reinvested and there is no return on capital. What's the growth rate going to be? It's a very simple one, no tricks here. Invested capital stays at $1 billion, return on capital stays at 7.5%. So this year's operating income is going to be $75 million. Next year's operating income is also going to be $75 million. So if you think about that as being your steady state, the company cannot grow, right? And we're going to start with that presumption. Is return on capital is stable and you don't reinvest any money, then you can't grow. But we're also going to point to exceptions where you can grow. And here's what can happen. If your return on capital changes over time, we're going to argue that even if you don't invest any more money, and it's a math issue, right? If your return on capital goes from 7.5% to 10%, even if you don't invest a cent, next year your earnings are going to be 33.33% higher than they are today. We're going to call that efficiency growth. And the essence of efficiency growth is you can have it but not forever. Why? Because you can get only so efficient. And this is the limit of cost-cutting growth, right? You can cut costs and grow, but you can't do it forever. So today we're going to talk about the link between return on capital and growth, because that's a link that I think you want to take away when you think about growth. And finally, and that's a word of question, if the return on capital can go to 10%, think about what you're going to, even if you don't invest a cent. Just think in terms of pure math. It's $75 million was your old operating income. Now it's $100 million. 75 to $100 million is a $25 million increase. In that year, at least, you're going to see a big growth rate because you were able to improve your return on capital. So today, that's what we're going to start with, is this question of what is it that truly drives growth? And you're going to see reinvestment and return on capital and growth rate all tied together. So let's go back to where we were. Let's talk about fundamentals. So I'm going to set up an algebra problem. Let's assume you have a company with $1 billion in existing projects, invest in existing projects, making a 12% return. For the moment, I'm just going to leave it unspecified, return on capital, return on equity. We'll come back. Generically, you got $1 billion invested, making a 12% return. Next year, it plans to add another $100 million in new investments, and it's going to continue to earn 12% on those new projects. Let's work out the math. The income next year is going to be $132 million, which is a 10% growth over this year's number. And if you think about where that growth is coming from, it's coming from the fact that they added to their investment base and maintained their return on capital. That's at the heart of what's called sustainable growth. Because if I work out the algebra, here's what it works out to. I reinvested 100 out of the 120 million, right? The 100 million got reinvested. That's a reinvestment rate of about 83.33%. I earned a return on capital of 12% on that. Mathematically, my growth in operating income is just my reinvestment rate times return on capital. So when we think about reinvestment, we don't tend to think of it in these terms, but it's a change in invested capital. It's what you're adding to your invested capital base. And if that invested capital base is earning the same return on capital, it's going to give me a growth rate. And if I can improve my return on capital, I get an oomph factor, right? If I make my return on capital go from 12 to 13%, in addition to my sustainable growth, I'm going to get an increase in my growth rate because I improved the return on capital on my existing projects. So keep both boxes open. Sustainable fundamental growth comes from reinvesting more and earning a decent return on capital. Efficiency growth comes from improving your return on capital. And for your company, whichever the company is, you might find that one is the basic driver of growth. If it's a mature company which is inefficient, your growth is going to come entirely from efficiency growth. So growth comes from how much you reinvest and how well you reinvest. That's basically it, right? You're saying, how do we measure that? It depends on what type of valuation you're doing. If you're doing an earnings per share model and you're looking at dividends per share, you're going to measure how much you reinvest with the retention ratio. You know what a payout ratio is? Percentage of net income that you pay out in dividends. So if your payout ratio is 40%, your retention ratio is 60%. So if you're looking per share growth and earnings per share, you're going to start with the retention ratio because that's what you're putting back into the company. And you're going to look at what return you make on that retention. And because you're looking at equity income, that return has to be measured as return on equity. So return on equity times retention ratio is your expected growth in earnings per share. This equation's been around for 60 years. It goes back to the 1950s. And many people, when they talk about sustainable growth, they're talking about this equation, retention ratio times return on equity. But there's a broader version of that equation, which we're going to introduce in this class. We talked about free cash flow equity. Net income minus reinvestment minus change in debt is free cash flow equity. If I take what you reinvest actually as a company, net capex and change in working capital, and look at how much of that comes from equity, and divide it by my net income, I come up with an equity reinvestment rate. It's like a retention ratio, but it's a richer measure, and I'll explain why richer. So the equity reinvestment rate, think of that as the updated version of the retention ratio, where you're saying, look, whatever companies hold back might not get reinvested, because remember, the retention ratio, you might actually take the money you don't pay out as dividends and leave it in cash. And I'm acting like you're reinvesting the money. Here I'm looking at what you actually reinvest. I'm measuring that reinvestment rate as an equity reinvestment rate. And when I look at your return equity, I'm going to look at what you earn as a return equity on your operating assets. Because I know what you earn as a return equity in your cash is going to be horrible. But I want to look at what... So I'm focused on what you reinvest by measuring what you reinvest and how well you reinvest with this. I'm going to call it non-cash return equity, which is net income without including the income from cash divided by the portion of my book equity which is not cash. So it's like a non-cash ROE. And then think about valuing the firm. When you value the firm and ask you how much are you reinvesting, I'm now going to look at how much you reinvest as net capex and change in working capital, but I'm going to divide that number by my after-tax operating income, not the net income. Notice how the definitions change as I go from per share numbers to equity numbers to firm numbers. It's a reinvestment rate. And I'm going to measure how well you reinvest by looking at all of your return, which basically means I'm going to look at after-tax operating income divided not just by book equity, but book equity plus book debt minus cash. It's the only place in finance that we use book values, return equity and return capital. And people always struggle with why exactly do we use book values. We'll come back and address that, but we're looking at how much you reinvest and how well you reinvest using three variants. Now let me go back to the retention ratio versus the reinvestment rate. As I said, the old-fashioned way of estimating sustainable growth always focused on retention ratios. I talked about one limitation. We assume that what you don't pay out gets reinvested in projects, but that's not true. Take a look at Apple, right? What it doesn't pay out doesn't get reinvested because it's got a $250 billion cash balance. But here's the other difference. What's the highest number a retention ratio can be? 100%. You can retain all your income. What's the lowest number it can be? 0. So basically, retention ratios are bound between 0 and 100%. You're saying, so what? What's the lowest number a reinvestment rate can be? Can it be negative? Remember, it's net capex minus change in working capital. If your depreciation exceeds your capex and you got working capital decreasing, you can end up with a negative reinvestment rate. So reinvestment rate can be negative. Can it be greater than 100%? Absolutely. You can reinvest far more than your operating income, especially if you're a young growth company. When you talk about reinvestment rates, you're relaxing both ends of the equation. And for distressed or declining companies, the fact that the reinvestment rate is negative is exactly what you'd expect. For high growth companies that have to reinvest a lot, your reinvestment rate is going to be greater than 100%. So the advantage you get with reinvestment rates is you get far more freedom to capture differences across companies. So what I'm going to do is I'm going to take each of these and work through very simple examples so you can see the fundamentals play out. Then I'm going to open the box and let the fundamentals get under stress because I'm going to let other things change. So my initial analyses, I'm assuming return on equity and return on capital are pretty stable numbers. And if I do that, the growth rate then comes out very simply using this equation. So the first equation, if I'm looking at long-term growth in earnings per share, I look at the retention ratio times return on equity. And we already said the retention ratio can never be greater than 100%. If I take that equation religiously, and some people do, I've already put a cap on your growth rate, right? Your long-term growth rate can never be greater than your return equity. So if you're a company with a 9% return equity, you're doomed. You can't have double-digit growth, no matter how hard you try, because the most you can grow is 9%. But within the constraints of that equation, that's what drives growth. How much are you retaining, and what kind of return equity do you have? So let's take an example with real numbers. This was in July of 2008, just before the crisis. I valued Wells Fargo. And the retention ratio for Wells Fargo was about 45%, and its return equity was 17.56%. Banks were doing really well. They had high returns on equity. And oblivious to the change that was coming, if you'd asked me what the growth rate for Wells Fargo is, with those numbers staying stable, because remember, this is about the future. If I assume they can maintain the return equity and the retention ratio, their expected growth rate is going to be about 8% a year. So that's in July of 2008. September 2008, of course, you had the crisis. And after the crisis, regulatory capital requirements got ramped up. Got ramped up because banks were in trouble, so regulatory authority said, you need more capital. So let's assume you're looking at Wells Fargo 2 months later. Nothing has changed about the company. It still has the historical numbers you had, but now you think going forward that Wells Fargo will require 30% more equity to do what they used to do in July of 2008. Let's work through the numbers. Even if I assume nothing has happened to my base numbers, and this is assuming that net income can be maintained, my book equity now has to be 30% higher than it was, which means my new return on equity is going to be much lower than it was before. I think it works out about 14% return on equity instead of 17%. And even if nothing else changes then, my expected growth is going to be much lower than it was before. So if you're valuing a bank or a financial service firm with regulatory capital requirements, and regulatory capital is expected to get tighter in your story, they're going to be raised, it's going to show up as a lower return on equity and a lower growth rate. Even if none of the inputs change, you could have the same net income you had before, but now you're going to grow slower because you need more book equity to generate the same net income. So that is a very simple earnings per share example. Let's dive into the return equity a little bit more. If you look at what drives the return equity, there are two ways you can end up with a high return equity. One is to take great projects, right? That's how the Googles and the Facebooks get there, really high return equity. The other is to do what people in real estate do. You know how they get a high return equity? They take average projects and they'll borrow up to the hilt. And here's how it plays out. If you think about your return equity, the base number you get is the return you make on your project. So let's call it the return on capital. And then you have a leverage effect. And take a closer look at the leverage effect. First, I measure how much you borrow with the debt to equity ratio. So the more you borrow, the higher the debt to equity ratio is. And then I capture the benefit of debt in the number inside the brackets. And the number inside the brackets is the return you make on your projects minus your after-tax cost of debt. So if you're able to borrow money at 4% after taxes and invest in projects that make 10%, you're going to get a jump in your return equity because you've replaced more expensive equity with cheaper debt. So this is like magic. I can pump up the return equity for a company, and I'll take you back in time to show you how this plays out. Late 90s was when I first started valuing Brazilian companies, and one of the first Brazilian companies I valued was a company called Brahma. It's now called Ambev. And when I valued Brahma, its return on capital was 19.91%. Really good return on capital. It also had a debt to equity ratio of 77%. It borrowed 77 cents for every dollar of equity. Its after-tax cost of debt was only 5.6%. So pause right there. You're making 19.91% on your projects. It costs you only 5.61% to borrow money. That difference plays out as a return equity of 31%. So I can actually decompose a return equity and say, this is how much comes from taking great projects. Why do I care? From a valuation perspective, which one is going to create more value? Value from your return equity being high because you have great projects, or return equity being high because you have leverage? Great projects, because with leverage you're going to get another shoe waiting to drop, right? Because even though your return equity is higher, what do I compare it to? Your cost of equity, and your cost of equity is a function of your beta, and if you borrow more money, your cost of equity goes up. So I need to know, when you tell me you have a 25% return equity, whether it's coming from taking great projects or whether it's coming from borrowing money, and this is a very simple way to break it down. So people have known this, played this game before. In fact, many people use this as an argument for borrowing money. My return equity will go up. It's an incomplete story. Of course your return equity will go up most of the time. Saying when will it not? I'll give you an example when it will not. Most of the time, but it doesn't mean your equity is becoming more valuable. It's just getting more risky. So I go back to my hometown every year or so for a very short visit because I grew up in Chennai, in the southern part of India. And I've been in the US now for 40 years, so I know very few people in Chennai anymore. So I go back, and after about 3 days, my family wants me to leave, so I leave. And I want to leave as well. So it's mutually acceptable that 3 days is the limit of what we can take from each other. But somehow people seem to find out I'm coming before I actually arrive. And invitations start coming in about, can you come in and talk at our company? And it's actually very difficult to turn people down because many of the people who are asking me are people I've known since I was a little kid. And about 15, 16 years ago, I'm on the verge of coming home. My uncle, who was chairman of the board of directors of a company, calls me and says, can you come in and talk to my company? Because we've been reading about how debt is good for return equity. We keep borrowing money, but every time we borrow money, our return equity seems to go down. Can you take a look at the numbers? So I did take a look at the numbers. They had a return on capital. It's a company called Titan Watches, actually a fairly well-known Indian watch company. It's part of the Tata Group. Okay? They had a 9.5% return on capital. Not bad, right? Remember, this is all in Indian rupee terms in a different age when inflation was much higher in India. The debt-to-equity ratio was 191%. He wasn't kidding when he said we've been trying. They've been obviously trying to borrow money a lot. They've succeeded in pushing the debt-to-equity ratio up. And in the process, they pushed the cost of debt after taxes up to 10.1%. You see the math problem you have? Usually debt helps you. Why? Because you're borrowing at a rate lower than the return on capital. You're borrowing here, you're paying out more than your return on capital. As you borrow money, your return on equity is going to implode. Now, hopefully this is not the scenario you face, but even in the scenario where debt helps you, you've got to be very careful because the net effect can still be negative. So that's the simplest starting point. If you have earnings per share, you can look at retention ratio and return on equity. Now let's take one step further. Let's talk about looking at free cash flow to equity and net income. And as I said, when you're looking at free cash flow to equity, it's probably better to separate cash from, income from cash from income from everything else. Because income from cash is income from cash. We know how to value it. So when you think about computing growth in net income, here's what I'm going to do. To get the net income from non-cash assets, I'm going to take your net income, subtract out from it the interest income from cash, which usually is either in the footnotes or in the income statement directly. So to get the net non-cash return equity, I'm going to take that net income and divide it by book value of equity minus cash. So think of this as looking at the equity invested in non-cash assets. So I have a non-cash return equity. The only difference is traditional return equity, I take net income and divide by book equity. Here I'm just netting the cash effect out. To compute the equity reinvestment rate, I actually measure what you reinvest. Why should I trust that if you don't give it out as dividends, you're reinvesting the money? So I take the net capex plus change in working capital. That's a total reinvestment. And to the extent that this is equity, I might look at, am I investing all 100%, 80%? So I'm going to multiply by 1 minus the debt ratio. That's a shortcut. If you want to net out the actual debt payments, you can do that as well. And I divide by the net income, I come up with an equity reinvestment rate. And in this particular scenario, my expected growth in net income is going to be equity reinvestment rate times my non-cash return equity. So let's take an example. From 2010, I looked at Coca Cola. Their net income was $11.8 billion. Their total book equity was $25.3 billion. Okay. So if I just took traditional return equity, I'm going to take the 11.8 and divide by 25. Their cash balance was $7 billion, and on that cash balance, they earned only $105 million income. And finally, the capex was $2.2 billion. Depreciation was $1.4 billion. Working capital went up by $335 million. And let's assume that during that period, the debt increased by $150 million. I have all of the ammunition I need to compute my numbers. First step, I computed what the equity reinvestment was, which is total reinvestment minus how much comes from debt. So it's capex minus depreciation plus change in working capital minus the debt increase because that reduced how much I had to reinvest. My total reinvestment is $957 million. My total non-cash net income, which is the total net income minus the interest income from cash, is 11.7 billion. And my book equity, if I take out the cash, is about 18 billion. So here's what the numbers look like. My reinvestment rate, my equity reinvestment rate for Coca Cola is a tiny number. It's only 8.18%. Coca Cola is not reinvesting very much back into the business. That's the bad news. The good news is when it does reinvest back into the soda business, its returns on equity are astronomical. Why? Because remember, they don't own bottling plants. It's just syrup. 63.87%. So even though they're not reinvesting much money, they can still show a fairly healthy growth rate. You think 5 is a healthy growth rate? For a company the size of Coca Cola, 5 is not bad. 8.18% times 64% gives me a 5.22% growth rate. So as you go from earnings per share to net income, you expand your definition of what you reinvest, and you change your definition of what you're earning on your equity. Any questions? Yes? Yep.
So you have in your first formula, you have net income minus interest income from cash will be 1 minus T.
Yeah.
Do we need to 1 minus T there?
Yeah.
There is no benefit. I mean, there's an income. I'm actually paying tax on it. There's no shield or benefit.
No, that's exactly what I wanted. Because remember, net income is an after-tax number. So let's take the algebra. Let's suppose you made 500 as net income from operating assets. And in my net income, you show 50 from cash. That 50 is after taxes. Because it went into my taxable income, I paid tax. The IRS doesn't allow you, if you have interest income from cash, to pay a lower tax. You still have to pay taxes on it. So what I'm doing is I'm adding back the after-tax portion, or I'm subtracting out the after-tax portion because that's what's in my net income. If I were looking at taxable income, my entire interest income from cash is going to be here. But because it's net income, if I subtract out the total interest income from cash, I'm subtracting out too much. No, it's 1 minus T. It's whatever's left over. So work it through. You'll see it's always going to be 1 minus T. Yeah. Any other questions? Yes?
What's your view on taking like average book equity at opening and closing?
Yeah, you can. I really don't. That's actually a good question. I'm going to come back and talk about it because all of these numbers rest on an accounting return, right? Whether it's return on equity or return. I'm going to tell you what terrifies me about the number. And why this might be the least of your problems. If that is all you're worrying about, you have very few worries. This is so far down my list of worries as to whether I want to use the average or the ending of the beginning number, that if I get to that stage, you could use average, you could use the beginning. There are actually different ways in which you can justify each. It's not going to make that much of a difference in the calculation unless you have a vastly changing company, in which case these steady state equations don't even hold. But we'll talk about the other concerns you have that are way above that on the list. Now let's talk about growth in operating income. Now I'm looking at total reinvestment and how well you reinvest. So I'm going to look at reinvestment rate. I'm going to look at what you reinvest as net capex plus change in working capital. But I'm not netting out debt and stuff because this is total reinvestment. And I'm scaling it to your after-tax operating income, not your net income. And your return on capital now is your after-tax operating income divided by book value of equity plus book value of debt minus cash. So now I'm looking at total return on capital. And my growth rate then would be the product of my reinvestment rate times the return on capital. The reason I kind of did all three back to back to back is often if you think of them as different equations, it's overwhelming because you take each equation and you list it out, you're going to get dozens of equations. It's actually the same equation. All that's changing is how I'm defining what I'm reinvesting and how well I'm reinvesting. So I'm going to take you back to 1999 and 2000, and I looked at Cisco versus Motorola. For those of you who don't know the history of Cisco, it went from being a $4 billion company in 1990 to a $400 billion company briefly in 1999. There was a period of time, maybe a week or so, when Cisco was the largest market cap company in the world. It's considered the ultimate success story. And Motorola had been around a longer time, it had its issues. So I decided to look at the 1999 numbers for both. And in 1999, Cisco's reinvestment rate was 107%. So what's Cisco doing? It's taking all of its operating income and putting it back and investing more. And its return on capital was an astonishing 34%. You're saying, what's so astonishing about it? When you're reinvesting that much, usually your return on capital drops off. But what made Cisco the star that it was, it had a high reinvestment rate and a really high return on capital. Well, guess what? If you ask me how quickly can Cisco grow, if it can maintain those numbers, and that's the key, if it can maintain those numbers, the growth rate going forward would be about 36%. You look at Motorola, return on capital is 53%. I'm sorry, reinvestment rate is 53%, not bad. The return on capital is about 12%, not bad. What's not bad times not bad? Not bad. So the growth rate is not bad either. You ask me, why can't Motorola grow at 34%? Pigs can't fly. When you have a 12% return on capital, it becomes much more difficult to get a 30% growth rate. So in 1999, you can see why people viewed Cisco as a star and Motorola as a dog. But just to caution you, because many of you will compute this number from last year for your company, you might get Cisco-like numbers. And you're going to get really excited. I've got my next Cisco on my hands. Just remember what happened to Cisco in the next decade. First, on the reinvestment rate, what did they do? They continued to reinvest like it was the 1990s. So if you look at 2001 through 2010, the reinvestment rate was 70, 80, 90, 100%. See, this is good. But in that next decade, the return on capital, which was 34% the previous decade, dropped off to 7, 8, or 9%. Cisco went from this value-creating giant to a value-destroying machine. And the reason it happens is very simple. What worked for you when you were a young, growing company stops working for you at some point in time. But you keep doing it because it used to work for you. So when you think about looking at the return on capital and reinvestment rate, unfortunately, those numbers all come from the past. You're not stuck with them. You still have to make a judgment going forward as to whether these numbers are sustainable or not. So now I'm going to focus on this question, because in all of these equations I have return on equity, return on capital. And I'll tell you what terrifies me about this number. What's in the numerator? Accounting earnings, right? Whether it's net income or operating income. What's in the denominator? I said this is the only place in finance where we use book values. You got an accounting number divided by an accounting number. And that terrifies me, because everything accountants do, often with the best of intentions, can undercut what I'm trying to do in computing return on capital. So let me step back. When I look at return on equity or return on capital, what's the question I'm trying to answer? Is this company taking good investments, right? That's what I want that number to tell me. And some of the things accountants do get in the way of my getting an answer to it. I don't know whether any of you have sleep trouble, but if you do, I have a solution for you. I have a paper I wrote on return on equity and return on capital that was so incredibly boring, I fell asleep multiple times while I was writing the paper. Right? And it was about all the things I needed to fix. So if you gave me a company, because I needed to find out, is it taking good projects, I had to spend time computing the return on equity and return on capital, so all the things I had to fix in accounting to get my return on capital to give me a measure. Let's start with the easy ones. Remember when we capitalized leases and R&D? It looked like a lot of work. You said, why are we wasting our time? One reason you capitalize R&D and leases is to get a better measure of return on capital. If I take a retail firm and I don't capitalize leases, I will end up with a return on capital that is way too high, because your biggest investment is in those lease stores and I'm not counting it. If I take a pharmaceutical or a technology firm and I don't capitalize R&D, I'm going to get too high a number because your biggest asset is off the books. So capitalizing leases and R&D, it was to get a better measure. Are you taking good investments? But here are the troublesome areas. In 2011, Chevron invested in this huge gas field outside Australia somewhere. It's a $55 billion investment. And this was done when oil prices and gas prices were at historic highs. So they invested the $55 billion. And I'm sure somebody did a net present value and said this is a positive net present. Remember, behind every terrible investment, there's a positive net present value project analysis that somebody's done and filed away. Didn't mean that they did a bad job, but at that time they probably used the oil prices then and the gas prices to project numbers up. So Exxon invested $55 billion. It took 5 years for the field to become operational. 2016, the field becomes operational. Oil prices are now down to $45 a barrel. Gas prices are down as well. Everybody knew that this was a bad investment now. in hindsight. But it was too late. You couldn't get the money out because it was in. Even the accountants figured out it was a bad investment. And when accountants figure out that something is a bad investment, what do? They wrote it off. They wrote off 25 billion of the 50. You're saying, so what? Let's say it's 2018. You look at Chevron's balance sheet. If you did not know that 25 billion had been written off, the book equity you're going to have is going to be $25 billion lower than it should be. You're going to come up with a return equity and return capital perhaps that are higher than the cost of equity and capital. You're going to conclude that Chevron did a good job investing when in fact it did nothing of the sort. So to get a decent measure of return on capital for my company, what do I need to do? I need to go back and fix every accounting action that was designed to help me and reverse it. Now do you see why it's a nightmare? Because it's not just last year. Everything that accountants have done over the history of the company is in there. So that's a problem. Here's another one. Last week, Kraft Heinz, or 2 weeks ago, when Kraft Heinz reported that earnings, they did an impairment of goodwill, right? Goodwill is a nightmare in many ways. But computing return on capital, it's one of the biggest problems to deal with. Many analysts, when they compute return on capital for companies, ignore goodwill as part of invested. They take it out of invested capital. The rationale is actually not a bad one. They say, look, goodwill is what you pay over and above book value, and what you pay over and above book value is for future growth. And because I'm measuring returns on existing assets, let me take goodwill out of the denominator. Sounds reasonable, right? It is true that goodwill is what you pay for future growth, but what else goes into goodwill? Control, synergy, and stupidity. Because when you overpay, where can it go? It goes into goodwill. So if you're a company that does a lot of stupid acquisitions, and I keep taking goodwill out of your denominator, I'm going to keep giving you this benefit of the doubt until I realize you're taking a lot of bad acquisitions. So with goodwill, actually, my argument is maybe we should divide into good goodwill and bad goodwill. And the way you make that judgment is if you have a company with a lot of impairments in its history, I have to factor that in deciding whether to keep goodwill in the balance sheet or whether to take it out. And this is exactly the kind of mind-numbing exercise you've got to go through to get the return on capital, especially if it's an old company. Get the return on capital and return on equity nailed down. Now the timing issue is an important one. If you feel that you cannot, and I'll give you the rationale, you cannot make money on investments you made at the very end of the year, right? Because you just did it. The argument is why not go to the average or even the beginning of the year, because you can't make money on investments you make the last 10 days, the last 5 days, the last 3 days of the year. I have absolutely no trouble using average return capital or even starting, because if you're using year-end convention for your cash flows, maybe you should be using starting book values to compute return capital. But that is going to be the milder problem to fix. So when you think about return equity and capital, these are some things, and if you're really, really, really excited about return equity and capital, I don't know why you would be, but if you are, then download that paper. It's 63 pages long of things you need to fix to get your return equity and capital nailed down. But my guess is with the actual numbers for your company, you're going to run into many of these issues. Now let's make things interesting. So far, everything I've talked about is how much do you reinvest, how well do you reinvest, take the product, you get the growth rate. And if this were mechanical, you'd do this for every company. The only problem is when operating income, that works only if your return on capital and return on equity are stable. You know what I mean by stable? It's at 15%, it's going to stay at 15%. If your return on capital is expected to change over time, in either direction, increase or decrease, you're going to get a second effect in your growth rate, and I'm going to call it an efficiency effect. And here's how it's going to work out. You're going to get the standard sustainable growth equation, return on capital times reinvestment rate, but to that I'm going to take the change in return on capital as a percentage of the existing. You're saying, what the heck are you doing? Let's take a very simple example. Let's assume you have a company with a 5% return on capital. Its reinvestment rate is 0. If I just stopped there and said, this company maintains its return on capital and its reinvestment rate, your answer is growth rate is also going to be 0. 5% of 0 is 0. But let's say I told you that it's going to reinvest nothing, but its return on capital is going to double next year from 5% to 10%. You know what the growth rate is going to be next year? 5% to 10%. So basically your income is going to double. Your growth rate next year is going to be 100%. You think that's too good to be true? Not really. Next year it's not going to be 100% every year, but for next year, the year in which your return on capital changes, you're going to get that growth effect. So remember that Motorola calculation I showed you, where I took not bad times not bad and came up with not bad? One of the stories that was being told about Motorola in early 2000 was they'd finally gotten around to fixing many of their troubles, that looking forward, that their returns on capital would move back up to much higher numbers. In fact, let's assume you buy into that. In your story, you say, look, I think Motorola is going to be able to improve its returns on capital from 12% to 17% over the next 5 years. Let's see how this plays out in your growth rate. Let's assume that Motorola can make 17% of its new projects right away, because so in a sense you can shift policy very quickly on new projects. So your growth from investing at 17% rather than 12% in new projects will be about 9% a year. So if they did nothing else than improve returns on new projects, your growth rate will jump from 6% to 9%. But because they're also improving returns in existing projects, you get a second term in the equation. It looks messy, but what I've done is I've taken the change in growth rate over the next 5 years as a percentage and then computed the compounded average. Because if I have a 40% improvement in my operating income over the next 10 years, it's less than 8% a year. There's a compounding effect. If you're in a hurry, just divide by 5. It's going to give you, close to the same answer. I'm getting an additional 7.17% in efficiency growth every year for the next 5 years. But I have to remember, at the end of the 5th year, that spigot gets turned off. I can't keep doing that because I've hit my efficiency limits and now I'm back to sustainable growth. So I'm going to give you an escape hatch. When you sit down to value a company and you pull reinvestment rate and return on capital from last year, many of you are going to be disappointed. Why? Because when you multiply those numbers, you might get a growth rate of 0.5%, 1%, 2%. And for many of your companies, that might be the truth. So don't fight the truth. But if you feel that you're underestimating growth, stop and ask what you might be missing. And one of the things you might be missing is the efficiency growth that this company could have, which could improve its return on capital, because then you get that second factor kick in and give you a higher growth rate during your growth period. So I'm going to put you to a test. I'm going to show you 5 companies, all of whom have exactly the same growth. And this is, I think, this is my pushback against people who look at growth. So high growth is good, low growth is bad. These 5 companies all look the same in terms of growth rate, all have 10% growth rates. But how they get the 10% is different. Company 1 has a reinvestment rate of 20% and a return on capital of 50%. So 20 times 50 is 10%. Company 2 has a 100% reinvestment rate, 10% return on capital. 100% times 10% is also 10%. Company 3 has a 200% reinvestment rate and a 5% return on capital. Its growth rate is also 10%. Company 4 has a 20% reinvestment rate and a 10% return on capital, but it also expects to improve its return on capital and existing assets from 10 to 10.8%. So you get that 8% efficiency growth, 10%. And the last company is reinvesting nothing, but it expects its return on capital to improve from 10 to 11%, so its expected growth rate is also going to be 10%. So all 5 companies have the same growth rate. So here's your task. I want you to rank these companies in terms of value of growth, from most valuable growth to least valuable growth. Let's start with the easy one. What's the company with the most valuable growth? What is it about one that makes it so valuable?
Every new investment is giving me 50%.
Because with putting in very little money, I get a lot of, it's if you think about the efficiency of growth, it's what kind of return on capital can you make on it. So company 1 has the most valuable growth. Which of the companies has the worst growth, the company you want to avoid? Company 3 has the worst growth. Why? Because it's growing and destroying value in the long term. So that was easy. 1 and 5 are fairly easy. Company 1 is the best. Company 3 is the worst. What's the second best company? 5. And what is it about 5?
Because they are not taking.
But it's only for 1 year. Right? That's the question you have to ask yourself. Am I better off with a company with 10% growth for 1 year, and then what happens after year 1 for company 5? It's going to be 10% and then it's going to be 0 growth.
If that change in existing investments could be maintained over time,
That's going to be
might
maintained.
better than one.
That could be, in which case you're getting a growth, in which case I'd have had to change the first part of the equation, right? Where I gave you the growth rate of new investments to be 10%. But I think company 4 will probably be better than company 5 because even though the growth is 10% next year, you at least get a 2% in. But what do I compare the return on capital to see if I create value? I compare to the cost of capital. So company 2 is running in place and company 4 is also running in place. So even though I get the growth rate, it might add nothing to value. So maybe we're back to company 5 being the second best company. Okay? So company 1, company 3 are the top and the bottom of the list. I wanted to think about the middle 3 companies. And what you're starting to do then is to think about, hey, is growth good or bad in my company? Your company might have great growth, but it might be destroying value. Your company might have average growth and be creating a lot of value. I want you to look past the growth rate at is this good growth, bad growth, or neutral growth? And that judgment comes from looking at the return on capital versus the cost of capital. Okay. So at the start of every year, I compute this for every company that's publicly traded, and I mentioned this before, but 60% of companies globally at the start of 2019 were earning a return on capital less than the cost of capital. Think about that. So the next time a company says we're going to grow faster, you should be running for the exit doors usually, not running to the company. So growth is not always a good thing. It can destroy value, it can do nothing for value, it can add value. It depends on that comparison. So we've talked about sustainable growth, we've talked about playing with return on capital. Let's take the most general case. Let's suppose you have a company where the margins are changing over time. What kind of company? Now valued Lyft. Could I compute the return? What's the return on capital for Lyft? If you define it as after-tax operating income, reinvestment divided by after-tax operating income, your reinvestment rate is going to be negative number. Your return on capital is also going to be a negative number. If I multiply those two numbers, I'll get a positive number, but what am I going to attach the positive number to? So if you have a company where margins are changing, you have no choice but to go to the top line. What's the top line? You've got to start with revenues and work down. So I'm going to give you this most generic way of estimating cash flows. And this is what's built into my FCFF simple Ginzu spreadsheet is this approach. So you're looking at a company, revenues are growing, margins are changing in either direction. Here's what you should do. Start by projecting revenues over time. By looking at what? Looking at the company, looking at the market, looking at you got to bring your story to play. Is Lyft a car service company or is it a logistics company? Is it just going to be a US company? Is it going to be a global company? You're saying, I don't know. You don't have a choice. You've got to make a choice and that's going to drive your revenues. So you're going to make your small revenues into big revenues. Second step, take a look at the margins. They're big negative numbers right now. And that's where you'd expect them to be. They're a young company. But you got to pick a target margin. What's a target margin? This is the margin you think your company will make once it gets past the growing pains. Again, you say, how would I know? You got to make your best judgment. What do you think margins look like for a car service company in steady state? Will they be closer to 50% or closer to 5%? That becomes your target margin. And over time, here's what you're going to do. You're going to move your current margin towards your target margin. So think about what's happening in your spreadsheet. Your small revenues become big revenues. Your negative margins become positive margins. Your losses become profits. This is magical. You can do it so easily on a spreadsheet. Much more difficult to do in a real company. What's the third and final step? To make your small revenues into big revenues, you got to reinvest. And I said the traditional ways of estimating reinvestment will not work. You can't take last year's capex, depreciation, working capital and project them out because there's nothing there. So you got to tie your reinvestment to the only number in your projections that's always positive, which is revenue. So basically, everything I do in terms of reinvestment is going to be connected to revenues. So here's what I'm going to do to estimate the reinvestment. I'm going to take the change in revenue every year, and I'm going to ask how much reinvestment will I need to get that change in revenue. So if I want to grow my revenues $1 billion, how much will I need to reinvest? And to estimate that, I'm going to use a ratio called the sales to invested capital ratio. It's exactly like the return on invested capital, but instead of dividing after-tax operating income by the invested capital, I'm dividing sales by the invested capital. So if I tell you that's 5, what am I saying? For every dollar of capital you invest, you get $5 of revenues. The problem, your revenues went up by $1 billion, right? To get $1 billion in revenues, how much will you have to reinvest then? You have to invest about 200 million because that's what 5-to-1 ratio. So that's basically what I'm going to do. And that reinvestment captures everything. Net capex, change in working capital, acquisitions, R&D, they're all in there. Revenues, margin, reinvestment. You're going to get free cash flows. And I'll take an example. I valued Tesla off and on. I'm due for another valuation. It terrifies me because I value Tesla. I get to hear from people who are a little crazy. Yeah. But Tesla has been always an interesting company to value, simply because the story can be so different. Is it a car company? Is it a tequila company? I don't know. No. You hear about the Tesla Quila that they've actually patented. You haven't heard about it? They actually have patented this Tesla Quila tequila that they plan to make. With the auto driving, maybe you could drink tequila and drive the car at the same time. I don't know. So this was in July of 2015. I wanted to value Tesla. Its revenues at that time were $2 billion. Tiny for an automobile company. Just to give you some perspective, Volkswagen had revenues of 250 billion. Audi had revenues of 60 billion. So it's a small car company with an operating loss of minus 21.8 million. So my task is laid out for me, right? Even if I'm optimistic, especially if I'm optimistic about Tesla, not even, because if I'm not optimistic, we know what will happen. If I'm optimistic, those small revenues have to become big revenues, and my losses have to become profits. In 2015, the story I told was of Tesla as more of a luxury auto company than a mass market auto company. And this was before Elon announced that he's going to make a $35,000 Tesla, which he's not actually delivered on, but that story was not even the mix. So I targeted companies like Volvo and Audi and BMW, all successful automobile companies in terms of revenues, and over the next 10 years made that $2 billion in revenues into $79.5 billion. I think I'm being pretty optimistic, raising your revenues 40-fold. So I made small revenues into big revenues. Their operating loss in 2015 was minus 1.08%. The target margin that I picked was in the 75th percentile of high-end automobile companies. This is an optimistic story. I keep re-emphasizing that because later on I'm going to show you the value that comes out of this story, and that value is well below the market price still. So I've picked a story where they're going to become profitable and move to the 75th percentile, 12% margins. So as my margins go from minus 1 to 12%, my operating loss becomes an operating profit. I'm making Tesla, at least on my spreadsheet, into a company that is successful in terms of revenues and is going to improve its return on capital. Last loose end, I've got to figure out how much they're going to reinvest. And to estimate how much they're going to reinvest, I use the sales to invested capital ratio of a combination of the automobile business and the technology business. Again, buying into their argument is we're going to change the way assembly lines are. Remember the old robots story that Elon Musk was saying about robots, and it didn't quite work out the way he expected, but I said, okay, maybe you find a way to improve it. And the sales to capital ratio 1.55 reflects, I think the automobile business is like close to 1, the technology business is 2.5, I kind of went 1.55. And here's how it plays out. Every year I take the change in revenue and I divide by 1.55. That gives me my reinvestment every year. So let's take year 1. I have operating income of 7.48 million. I don't pay taxes. Why? Because I have enough losses to cover the rest of eternity. Okay? I lost money for so long that I don't have to think about paying taxes for a long time. So basically, I'm using my NOL carried forward, so I pay no. So I have 7.48 million after-tax operating income. You subtract out 844 million from it, your free cash flow to the firm in year 1 is minus 837 million. Notice in my optimistic story what my free cash flows look like. For the next 9 years, I have huge negative free cash flows to the firm. Why? How many cars does Tesla sell right now? And what will 79 billion require me to have? Probably 1 million cars. I've got to build assembly lines. I can't keep putting up tents and saying, oh, the tent will work. Can't work for the long term. That is the effect of being in a capital-intensive business and wanting to become a large company. As you go through time, I keep revisiting this valuation because I try to give the benefit of the doubt, saying maybe there's a more efficient way of investing the capital. but based on my free cash flows, I still get a large value, but it's coming from the fact that I build a company of substance by the time I get to year 10. But the three big numbers are revenue growth, target margin, sales to capital. For those of you who opened up that Ginzu spreadsheet, those are the three inputs I ask you for your company. They don't have to be numbers from last year. These have to be your expectations for the future, given the story you're telling about the company. So I know that a couple of people in the class at least will be doing Teslas now. And the story you got to ask is, what's the story I would tell about Tesla today? What's the margin that I see for Tesla? And the story can give you very, very wide variations in all of those inputs, leading to differences in value. So that's the most general way of estimating cash flows and growth and revenues. Any questions? Yes?
In the other page, can you go back one?
Yep.
No, the other one.
Which direction?
With the growth rate
Yeah.
for Tesla.
Oh, for Tesla, okay.
The 65% in revenues is the previous one.
Oh, sorry, okay.
The 65%, did you get that?
Luisa asked a great question. So why did you pick 65%? I actually didn't pick the 65%. You know what I picked? I picked the end revenues I wanted to have at the end of year 10. That's where the story drives it. Because if I sit there, and this is something I'm going to come back and re-emphasize when we talk about value growth companies, you will go crazy if you go sequentially. You know what I mean sequentially? Year 1, year 2. Because by the time you get to year 3, you'll have no hair left because you've been pulling your hair out. When you value young companies, it's your end game that drives the valuation, not the middle game. So what I started with was the revenues in year 10, and I got that by looking at the luxury auto companies and asking, what would large revenues look like for this kind of company? And an automobile company, $80 billion is a fair amount of revenues. And then I said, what growth rate would I need to get there? So I'm willing to concede. So if you fought me on year 1 growth rates, I think it's 71.63%, you can have that. You want year 2, you can have that as well. You give me the starting and ending numbers in the valuation, I control the valuation. That's why when you see young companies come out with their first earnings report and investors freak out, it's like your kindergartner coming back with a report card from school, and you take one look and say, oh my God, you're never going to college. You might be overreacting here. That first year's growth rate is not what I'm worried about. It's, are you changing your end story? And somebody's got to get this message through to Elon Musk. Because I think he's become distracted by this objective of, you notice how much he's focusing on, we're making money, we have positive free cash flows. It's not it's actually going to undercut his big story. This company's value comes from having a big story. And that big story, I'm willing to live with losses. I'm willing to live with negative cash flows because I see the story unfold. My worry is if you get how do you make cash flows positive in year 1? Very simply, if Tesla wanted positive cash flows in year 1, they can do it. What do they have to do? Don't reinvest. So you have positive cash flows, but what have you accomplished? Your future lies in producing more cars. If you don't reinvest, there'll be no assembly lines. You'll have what happened last year happen over and over again. Remember last year to get to 5,000 cars, that drama for 6 weeks where he slept on the assembly floor and he said, no. You don't want that. You want to reinvest because that's what drives your value. So when we talk about stories and numbers, that's what forces you to think about what is it that I'm going to be looking at in this company. So let's summarize all the different ways of thinking. When you think about growth rates, a growth rate can be either an equity income or an operating income. That's the first question to ask. What am I looking at? If it's equity income, it can be you're trusting analyst to give you the growth rate. We talked about the minuses of doing that. You can look at historical growth rate. And for some companies that might work, or you might have to do your fundamentals. And if it's fundamentals of equity income and it's earnings per share, you can look at return on equity times retention ratio if the return on equity is stable. But if return on equity is changing, you're going to get that second term in the equation, the efficiency growth. If you're looking at net income, then you've got to look at return on equity and equity reinvestment rates rather than retention ratios, the broader term. And again, you're looking at changes in return on equity over time. With operating income, you don't have analyst estimates usually of operating income for the long term. You have fundamentals and you have historical. Again, if you trust historicals, I'm not going to fight you because then you're telling a story of the status quo. Things are going to continue to be the way they are. And for some companies, that might be perfectly okay. But if you want to go down the fundamentals route, then you're going to look at what's your return on capital. If it's stable, then your growth rate is going to be your retention ratio times return on capital. If it's not stable, if it's changing, you get the efficiency growth. And if it's, all bets are off, margins are shifting every year, have negative return on capital, then you might have to do what we just did. Project revenues, get a target margin, think of how much you will have to reinvest to make your small revenues into big revenues. I know I rushed through the Tesla valuation, but as I said, once we've done this, we're actually going to come back to value companies. I'm going to value Tesla, I'm going to value Amazon, and you're going to see this process play out with companies, and you're going to start to notice what you should expect to see with young companies in terms of earnings and cash flows. Now let's get to the big enchilada. So you do a DCF valuation. We all know, if you've ever done a DCF valuation, what the biggest number in every DCF is, right? It's the terminal value. Let's talk about why it's there. What did we say a value of an asset was? The present value, the expected cash flows over the life of the asset. And if you're valuing a publicly traded company, you have a problem. Your company could keep going and going and going forever, and you cannot estimate cash flows forever. That's why we need closure. Because since we cannot estimate cash flows forever, we have to stop estimating cash flows at some point in time, and we can't ignore what happens after that point in time, so we estimate a terminal value. So I'll show you the three ways of estimating terminal value, one of which should never be used, but it's used in 80% of all discounted cash flow valuations. And I'm going to ask you to guess which one it is. There are three ways you can estimate terminal value. One is a liquidation value, which is you stop your company after year 10, you sell off all its assets for whatever you can get, and you put it as liquidation value. The second is to assume something about your cash flows beyond year 10, that they will grow at a constant rate, and we'll come back and address what that rate can be, and to estimate a perpetual growth equation, come up with the terminal value. And the third is to apply a multiple to your year 5, year 10 EBITDA or EBIT or revenues to come up with the terminal value. Which one of the three should never be used if you're doing an intrinsic valuation? Remember we talked about value versus price? You can either value a company or price the company. If your biggest number in a DCF comes from using 8 times EBITDA in year 10, it's not a DCF. It's a forward pricing with a patina of cash flows up front to fool me. But while I'm fooled, you slip in 8 times EBITDA. I said 80% of all valuations use multiples. And I'm not exaggerating. Almost every banking valuation, if you look at the terminal value, comes from using a multiple. In fact, they have a little multiple table that I think is built into every spreadsheet, 6 times EBITDA, 8 times EBITDA. It must be just hard-coded in there. That shows you what will happen to the terminal value if you use 6, 8, or 10. And frankly, I don't want to use any of those. So frankly, I'm not going to look at the table, but you can see the price. So I call these Trojan horse DCFs. Remember the legend of the Trojan horse? You don't, right? I mean, this is like 4,000 years ago. The Greeks and the Trojans had this war. In those days, I think they had nothing to do. You had no Netflix, no binge watching. So wars lasted forever, like 15-year wars. So the Trojans are in the city, and the Greeks lay siege to the city for years and years. 5 years into the siege, the Greeks come to the Trojans with a gift. Let me ask you a question. You're in a city, you've been laid siege for around 5 years. Somebody offers you a gift. What's your first reaction? I don't want it, right? But the Trojans must not have been very bright. This is exactly why the Trojan Empire didn't last that long. They said, these nice Greeks are offering us a gift. And the gift is this gigantic wooden horse. I don't know what you do with the gigantic wooden horse. So they wheel the wooden horse, because in those days you actually had walls around the city. And they open the gate, and the horse comes in. And in the middle of the night, the legend is the back of the horse opens up, and all these Greek soldiers come out, and the city falls. Hence the term, beware of Greeks bearing gifts, I think. I think that's the original. You're saying, what's this got to do with discounted cash flow valuation? Think of your DCF as a big wooden horse. Think of the terminal value as a door at the back of the horse. Think of the pricing that comes out as what comes out of the horse. You've lost control of your DCF if you use 8 times EBITDA or 10 times EBITDA or 6 times revenues or 5 times earnings or whatever you decide to use to get your terminal value. So your choices are really between liquidation value and a perpetual growth model. I'll tell you when I use liquidation value. You're an owner of a restaurant. You ask me to value your restaurant. You have a 20-year lease, and you're 53. You know what? I'm going to estimate your cash flows for 20 years. The end of the 20th year, I'm going to shut your restaurant down. First, because you're going to be 73, and you probably want to retire. And the other is, your lease runs out. They're probably going to raise the rent. Rather than sit there and figure out how much they're going to raise the rent, I'm going to say, the end of 20 years, I'm going to liquidate your business. Think of it like a traditional capital budgeting project. There's a salvage value at the end. If you do that with a going concern, if you try to do that with a Coca Cola or a Facebook, you're going to come up with a really low value because the liquidation value there is very small. That option is there, but you won't take it. And for those companies, we use the perpetual growth model. And you've seen this, right? Cash flows 1 year after. It's always got to be 1 year after your final year. So if we want a terminal value in year 10, you always need cash flows in year 11. Why? Because that's how present value equations work. The first cash flow is always 1 year after your starting point. So to get my terminal value in year 10, I need cash flows in year 11. Divide by R minus G. So that's it, right? That's how terminal values are computed. But let's take a look at that growth rate. This is a growth rate you can sustain forever. So let's put some math limits on that growth rate. It cannot exceed the growth rate of the economy in which you operate. Everybody agree with that? If a company grows at a rate faster than the economy, it's going to take over. So basically, there's a limit. We'll talk about what you can use to get a proxy for that growth rate. It can be 0. That option is always on the table. It can be negative. I think people are often unaware of the fact that you can make the growth rate minus 3% a year forever after year 10. You're saying, why would I do that? In fact, that's probably closer to reality than what we do of applying a 3% growth rate. Notice every company in discounted cash flow models becomes this gigantic company. In today's day and age where you've got shorter life cycles for companies, maybe we should start using this option more. So you can put in a negative growth rate forever. And I'm going to actually argue that a very simple proxy for what that growth rate in the economy is forever is what you've used as your risk-free rate. This gets me a lot of heat. So let me explain why I use the risk-free rate as my proxy for the growth rate. I kind of talked about when I talked about the implied equity risk premium. But let me give you my basis. I'm sorry. Think about what goes into risk-free rate. The risk-free rate is expected inflation plus an expected real interest rate. The nominal growth rate in an economy is expected inflation plus expected real growth. So in the risk-free rate, you got a real interest rate. In the nominal economy, you got real growth rate. So the real interest rate is what you've agreed to pay to the lenders in the form of goods and services. So let me start with the basic proposition. In the long term, the real interest rate cannot be cannot be higher than the real growth rate. You see why? Because if I promise people 3% more in goods and services and I'm growing only 2% a year, I'm going to run into a problem somewhere or the other. So it cannot be lower. But it could be higher. And to take a look at how much higher, I went back in time. I looked at the T-bond rate over different periods. So that's what you observe as the risk-free rate in US dollars. I looked at the inflation rate and real GDP growth every period. And when I add up the inflation rate and real GDP growth, I call it my intrinsic risk-free rate. It's what I would get if I took growth and inflation. Across the entire time period, here's what I get. My T-bond rate was 5.93%. My nominal GDP growth was about 6.67%. Over that entire period, my inflation rate plus real GDP growth gave me 0.74% higher. But if you take a look at more recent time periods, especially as you go to 81 through 2015, you can see very quickly that numbers have started to settle down. The T-bond rate and the nominal growth rate have become numbers that are very close to each other. In fact, if you go back all the way to 1950 and you look at the best predictor of nominal growth in the US economy at the start of every decade, it's a T-bond rate. So my defense for using the risk-free rate is, look, historically over very long periods, it looks like the T-bond rate is a good proxy for nominal growth. I'm going to use that as my cap. That's my first justification. The second is when you do terminal value calculations, whether you like it or not, and you use a risk-free rate from today, you're implicitly making assumptions about the future growth in the economy, future inflation. Let's suppose you're doing evaluation. How many of you are doing evaluation in euros? You don't even pick up a company. You haven't picked a company yet. Okay, good. You remember what your risk-free rate was in euros? 0.4%. It's somewhere, it's 0.3, 0.2. If you use a 0.4% risk-free rate, what are you building into your denominator? Low growth and perhaps even not even inflation, maybe even deflation, right? So in your denominator, you're building in low growth and low inflation. You're saying, so what? Then you get to the numerator. Now you're talking about your company growing over time. See how you can't magically assume that you're going to revert back to a high growth, high inflationary economy there? If you assume low growth and low inflation in your denominator, you got to be consistent, assume low growth and inflation in your numerator. That's why I keep the growth and the discount rate kind of in place. Because if you're not careful, that R minus G can do deadly things to your valuation. You can have Buzz Lightyear valuations, right? As G moves towards R, you're going to infinity and beyond. I mean, that's, because it's a math problem. And I've seen people do that. They take 3 and 3.5, 4, 4.55, and as you move towards R, of course the terminal value is going to blow up. But it should never happen in the real world because you're going to cap the growth rate at the risk-free rate. So if you decide to go above the risk-free rate, that's fine, but have a really good rationale for why you're doing it, because this is the way bias can easily enter into your valuation. You want a higher value for your company, you're going to play games with that growth rate forever. And that's a very dangerous place to be playing games. Second, don't wait too long to put your company into stable growth. Notice my lift valuation, you remember how long my growth period was? 10 years. I've never used a period longer than 10 for a growth company. You see, but there are companies that have grown for longer than 10 years. Yes, there are, and we can name them, right? Coca Cola, Microsoft, Walmart. You cannot value a company to be the exception. You have to think of something that you can claim for yourself. So don't wait 25, 30, 50 years just because it's a young growth company. In fact, later in this class, I'm going to show you a graph that should scare you about growth companies, about how long growth lasts at a typical growth company in the US. It's not even 10 years. It's 3 to 5 years. So when I go to 10, I'm already at the 90th or the 95th percentile of growth periods. So don't wait too long. Just because you have a young growth company with lots of potential, don't get carried away and use 25 or 30 years. And remember, it's not, we looked at that table, it's not growth that creates value, it's growth with excess returns. So think about not just how long your company will grow, but whether it's earning excess returns, because if it stops making excess returns, it doesn't matter how much you grow. And that basically ties back to competitive advantages and barriers to entry. If you look at my lift valuation, I've kind of wrestled with it kind of unevenly because I'm saying, what's the competitive advantage here? And the competitive advantage you come up with for ride-sharing companies is a networking benefit. Once enough drivers become part of your network, it becomes very difficult for somebody else to enter the business because you got the customer. The flip side of that is, unfortunately, the ride-sharing companies haven't figured out a way to make those linkages sticky. You know what I mean by sticky? Which is drivers are free agents, right? So the way they've designed the ride-sharing business is, so when you think about competitive advantages, this is why you need to think about it. Because if you have strong competitive advantages, you can grow for a much longer time period. So now let's bring that into our terminal value equation. When you think about growth rate, remember I said growth can come from fundamentals and can come from efficiency. And when you're growing for the next 5 or 10 years, if you tell me, I'm going to get 7% from efficiency and 6% from reinvestment, I'm going to say, okay, it's your company. You have a story to tell about improving efficiency, and that increases your growth rate. But you get to year 10, and you're now in steady state. You're now a stable company. Efficiency is off the table. You can't keep growing because you're getting more efficient forever. It's got to come entirely from fundamentals. So this is the place where that sustainable growth equation comes in with weight. Because here's how it plays out. If you tell me what your growth rate is forever, I can figure out how much you need to reinvest by looking at what kind of return on capital you can generate. Because your reinvestment rate is going to be your growth rate divided by your return on capital. In fact, here's the full version of the terminal value equation. You start with the after-tax operating income, or the operating income in year 11, n plus 1. You multiply by 1 minus the tax rate. You're saying, why can't I just use the tax rate from year 10? Remember we talked about effective tax rate versus marginal. You might decide to move to the marginal tax rate. But then to figure out how much you reinvest, you got to look at your growth rate, which is capped at the risk-free rate, and at your return on capital. 1 minus the growth rate divided by return on capital. And in the denominator, you have cost of capital minus the growth rate. That full version of the terminal value gives you far less room to run than the version which says cash flow in year 11 divided by R minus. And here's why. Let me give you a very simple example. of how the terminal value will change for a company. I took a hypothetical, a very simple company. You're in your terminal year. Here's what the numbers look like. Your operating income after tax is going to be 100 million year n plus 1. I've computed the terminal value for this company as a function of two variables. What the growth rate is in perpetuity, from 0 to 3%, and what kind of return on capital this company will earn in perpetuity. So this is all in steady state. The company's cost of capital is 10%. Let's take the middle column. As my growth rate goes from 0 to 3%, that's good, right? I'm increasing the growth rate. Take a look at what my terminal value is. Under the 10% return on capital, my terminal value remains 1,000 no matter what. How is that possible? I thought growth was good. I'm increasing the growth rate, my terminal value is not changing. So as my growth rate goes up, my denominator gets smaller, right? That's a good news. What else is changing though as my growth rate goes up? You go to the numerator, what's in the numerator? What I need to reinvest. So as my growth rate goes up, I have to reinvest money to get to the same growth rate, which means my cash flows are lower, my denominator is lower. And when the return on capital is exactly 10%, my terminal value stays the same as my growth changes, because whatever good stuff I get from growth is exactly offset by the bad stuff. It sounds almost magical. But think of what I've just said. If you earn a return on capital of 10% and your cost of capital is 10%, when I look at a project, what's the net present value of a project that earns exactly its cost of capital? It's 0. What happens to your value as a company when you take a project with a net present value of 0? Nothing. What if you take 100 projects with a net present value of 0? 0. Once your return on capital is equal to your cost of capital, growth no longer matters. My first valuation book came out in the late 80s, and it came out at about the same time as the McKinsey valuation book. And those are the only two valuation books out there. And the McKinsey valuation book, if you look at the terminal value equation, it's NOPLAT, which is their version of after-tax operating income divided by cost of capital. There's no growth in the equation. And people would email me saying, how come there's no growth in the McKinsey terminal value equation? To which my response is, why aren't you emailing McKinsey? Why are you emailing me? Right? Actually, it wasn't even emails. It was letter mail. They probably thought I hung out with the McKinsey people all the time. I never even saw them. But there's actually a very simple reason. McKinsey was very rigid in what it assumed in steady state. Their argument was, no company can earn more than its cost of capital forever. So once you get to steady state, we're going to set the return on capital equal to the cost of capital. What do we say happens then? Growth ceases to exist. So might as well take growth out of the equation. So if somebody shows you a NOPLAT divided by cost of capital equation, don't tell them they're wrong. It's perfectly okay if your return on capital is equal to the cost of capital. If your return on capital is greater than the cost of capital, what will happen as my growth goes up, my terminal value will go up. Not because the growth is going up, but because I have excess returns which are positive with the growth rate. And if my return on capital is less than the cost of capital, take a look. As I increase my growth rate, my terminal value will actually decrease. The big assumption in your terminal value calculation is not the growth rate you assume, but the return on capital you assume with that growth rate. In fact, McKinsey's own book kind of undercuts their rigidity because they talk about returns on capital going towards 0. And this is from a journal called McKinsey Quarterly. You can actually get on the McKinsey website and sign up for it. It's a collection of pragmatic, practical articles. So one of the articles I looked at what happens to growth to companies over time. And you can see growth declines towards the growth of the economy. So that's backing for terminal value. But it also looks at returns on capital at companies, and it finds that returns on capital at companies actually stay elevated for extended periods. Which is part of the reason I want to preserve that degree of freedom when I get to a company like Coca Cola to let the return on capital stay above the cost of capital, even in perpetuity. So remember that linkage, but also keep that freedom for your company to make a judgment that your company could earn more than its cost of capital, perhaps forever. And finally, a lot of terminal value calculations, you see analysts make the following set of assumptions. They'll say, my company will grow at 2% a year forever. Okay? It's a mature company. Okay? Mature companies, CapEx offsets depreciation. Not okay, but I'm going along here. And there are no working capital needs. So let's work through the math. CapEx offsets depreciation means net CapEx is 0. No change in working capital is 0. 0 plus 0 is 0. We're on track here. 0 divided by any number is 0, so that gives you a reinvestment rate. What's your only growth rate you can assume if we assume CapEx offsets depreciation and there are no working capital requirements? The only growth rate that's consistent with those assumptions is a growth rate of 0. If you assume a 2% growth forever and you allow net CapEx to be 0 and change in working capital to be 0, you create a money machine. Your terminal value is going to be overstated. And of course, when I bring this up to analysts, you know what the response is, but what if I'm growing just at the inflation rate? You see the logic here, right? My capacity doesn't have to grow. I'm just raising price. What's the pushback against that? It's true, you don't have to increase capacity, but you have to replace old machines with new machines, right? You can't selectively count on inflation on the good stuff and not think about it when you talk about reinvestments. If you have to replace old equipment with new equipment, there's inflation in your economy, guess what? Even though your capacity stays stable, you will still have to reinvest money. So there is no escape hatch here. If you put in a growth rate, you have to have a reinvestment rate that will bring in that growth. Last thing for today, and we'll end. When you put your company into steady state, make it a mature company, give it the characteristics of a mature company. Like what? Mature companies don't have 15% cost of capital. They have cost of capital closer to 7.5% to 8%. That's actually the median cost of capital for a US or a global company. So you have to bring your cost of capital down. Mature companies don't earn 50% returns on capital. I said they can earn above the cost of capital, but it's going to be much closer to your cost of capital. Mature companies, it's not just the growth rate, but the rest of your characteristics have to match the growth rate. That's why you can't take the cash flows in year 5, project them out an extra year and compute a terminal value, because you might not be internally consistent about treating your company as a mature company. So that's it for today. We'll continue with picking a model next session.
Question on the CapEx driver as sales relative to reinvestment rate. Yeah.
Net CapEx plus change. It's a composite.
Oh, it's net CapEx.
It's net CapEx plus change.
So that's gross CapEx minus the depreciation. So that accounts for the. Is that how you disentangle maintenance and growth CapEx? Basically.
Ultimately, whatever comes out of the sales. So if you have no growth in your sales, what happens to reinvestment? It goes zero.
Right.
CapEx offsets depreciation. So
Okay.
basically it takes care of your because all you have is maintenance CapEx, and you make the assumption that maintenance CapEx and CapEx offsets depreciation. If your sales is relatively flat, your reinvestment is growing. If you want your sales to grow, then you have it.
Right. But in this case, we're not disentangling.
Ultimately, the both is what does it matter what maintenance?
You could value like the growth in the stable.
CapEx offsets depreciation is a standard maintenance CapEx.
Right.
So the maintenance CapEx goes, net CapEx is zero.
Right. Right.
So there's nothing you will learn by looking at net CapEx beyond. Any net CapEx is positive, and historically we know that is growth.
Right.
So to me, there could be growth CapEx. You could be actually spending a lot more money just maintaining your existing assets and calling it growth CapEx. While you're in a high inflation environment, we're replacing old equipment with new equipment. Costs a lot more. And that's why these lines between maintenance and growth CapEx are compulsory. And ultimately, the bottom line is you have a growth rate, you have a reinvestment, you have a cash flow. Why does it matter to me that reinvestment is good? Maintain existing assets, because it's already going to be in the growth rate. So it's good reinvestment. I'm going to come up with a value that is higher. Bad reinvestment, where I'm getting a low growth rate and reinvesting all this money. It takes care of itself in the composite valuation.
Right. I'm just thinking from the point of view of forecasting is
But forecasting maintenance capital traditionally it's been very easy. You just said equal to depreciation.
no, but I'm saying if you wanna give a value to like what's the maintenance capex of like on a steady state environment, what's the value of the company without any growth? And then you can back
equal to
out.
depreciation. That's how you do it. When capex offsets depreciation, that's a standard maintenance capex assessment. That's what maintenance capex. So when
Right.
you look at maintenance capex calculations, even though it's a separate line item,
Right.
in steady state, when you say capex offsets depreciation, you're doing maintenance capex, and that's all you're doing.
Right.
You have no growth. You have a net capex of zero.
But like you're saying, if there's inflation.
Yeah, that's why
Yeah.
you might end up with maintenance capex destroying value, but that's why I'm not so caught up in what's maintenance,
Right.
what's growth, because it's all coming out of my cash flows.
Right.
If you're doing it just to maintain existing assets, I'm deeply screwed.
Right.
Because now I'm not going to get much growth. You're putting in all this money to keep going the way you are. I'm going to end up with a much lower value.
Right.
So what I call it becomes almost irrelevant, right?
Right.
And I'm trying to draw lines in the capex that are really arbitrary lines right now. I'm saying it's all capex. Give me your growth. Give